When it comes to making the most of your savings in retirement, there are three main approaches people take. The first approach is the simplest, but over time it can become very difficult to sustain, and that's to simply withdraw a static amount of money each month or year from your nest egg and just leave it at that. The second approach is arguably the most popular, but it does have its fair share of drawbacks, and that's to adjust your withdrawals every year for inflation in order to maintain your buying power over time. This is the category that the popular 4% rule falls into. The third approach has you adjust your withdrawals every year based on the performance of your investments, or sometimes the performance of one aspect of your investments, such as the amount of dividends you earned. These types of approaches tend to have a lot of variance in the income they allow you to generate off of your savings, but they do have the benefit of being extremely unlikely to drain your savings if you're able to stick to them. Today we examine a strategy from that third camp, known as the variable percentage withdrawal method. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. Before we get into the analysis for this approach, I want to discuss how we'll be grading the strategies in this series. Basically, we'll be looking at 4 criteria. First is how much income the strategy generates. More income is obviously better, but we'll also be giving a little extra credit to strategies that generate additional income early on, since we're more likely to be healthy and energetic enough to take advantage of the income in our younger years than we are when we're 90-somethings. Second is risk and sustainability. This criteria basically measures how likely you are to outlive your money using a strategy, as well as how easy or difficult it might be to follow the rules laid out by the strategy. Third is the predictability or stability of the income the strategy generates. Basically, this criteria looks at how often your income rises or falls on an inflation-adjusted basis from year to year, and how big those changes are. And fourth is how well the approach manages to maintain or raise your buying power over time. Which criteria will ultimately be the most important to you will depend on your goals, financial situation, and personal preference. And because the performance of a withdrawal strategy is often heavily influenced by the mix of investments you happen to have, we'll also be looking at each approach under a conservative, moderate, and aggressive asset allocation as detailed in this chart. With that being said, let's get into today's strategy. So, real quick for those who don't know, here's how the strategy works. According to the members of the Bogleheads forum who created and popularized the strategy, it is kind of a mixture of the fixed percentage strategy and the 1/n method that we covered last month. First, just like the 1/n method, you figure out how many years you want your savings to last you. Just for the sake of this example, let's say that you retired really early at the age of 45 and wanted your money to last you 55 years, so that way you wouldn't run out of money before age 100. In this case, your N value would be 55. Then you determine what your current asset allocation is. For instance, if you were using the moderate allocation that we just went over in the previous section, your asset allocation would consist of 60% stocks and 40% bonds. With those two data points in mind, you then consult the following chart to figure out what your withdrawal rate for that year should be based on those two factors. As you can see from this chart, based on our asset allocation and the number of years we want our savings to last us, our withdrawal rate for the year would be about 4.2%. On a $1 million nest egg, this would mean roughly $42,000 in income. Each and every year, you will repeat this process using updated figures for whatever the current value of your nest egg is, as well as your N value, and I suppose if anything changed, your asset allocation. For those who are wondering how exactly the withdrawal rate percentages in this table are calculated, I'll leave a link to the Bogleheads wiki, which has a link to the variable withdrawal percentage spreadsheet that was used to make this chart. But basically what they do is come up with a growth trend for each asset, which they describe as literally a wild guess that aims to represent something in between the historical low and high returns for that asset. So for stocks, they used 5% per year and bonds was a little under 2%. And then they used those figures in conjunction with the number of withdrawals you had left to make in a simple minimum payment function in order to determine withdrawals. From there, all you need is simple division to figure out what the withdrawal rate is based on the value of your nest egg. So that's how the variable percentage strategy calculates its withdrawals. But how well does it stack up in regards to our 4 criteria? As usual, we'll start by examining its historical income generation capabilities. I should note that for the remainder of this video, I'll be assuming that we want our money to last us 30 years to keep things consistent between different videos in this series. So the first factor I look at when analyzing withdrawal strategies is income. As you can see from the chart on your screen now, in terms of income generated on a $1 million nest egg, the variable percentage approach generally outperforms the $40,000 a year income that the standard inflation-adjusted approach would generate. And sometimes it's by pretty pretty substantial amounts. The story remains largely the same when we look at the performance during the early years of a drawdown period, with the variable percentage approach generating north of $40,000 a year, even when looking at the minimum income figures for all three allocations. The second factor I look at when analyzing withdrawal strategies is risk and sustainability. Risk, or the likelihood that you'll outlive your savings, examines a couple of metrics. The first is what I call the approach's survival rating, or the percentage of possible retirement starting dates that would have avoided running out of money over a specific length of time. Like I said, today we'll be using 30 years as the time frame to determine if an approach survived retirement. The second is what I call the approach's depletion time, or how long the approach survives in its worst-case scenario. This is important to consider because while two approaches can have the same survival rating, they can have wildly different worst-case scenarios. And if you're not completely sure how long you want your money to last you, that can make a difference in your decision. Sustainability considers how easy or difficult an approach is to maintain, given the experience its strengths and weaknesses are likely to produce. Starting with the survival rating, we see that the variable percentage withdrawal strategy never manages to make it a full 30 years before running out of money, at least according to the spreadsheet, but this is a bit of an illusion. So what the spreadsheet does is look at the ending net worth at the end of each year to determine if the approach survived the year. Since the withdrawals are being made at the start of each year, and we're using 30 as our end value in this analysis, our 30th and final withdrawal at the start of year 30 will be equal to 100% of whatever's left in the portfolio. Therefore, by definition, there would be nothing left over by the end of the year. For our purposes, it does make it through all 30 withdrawals just fine, regardless of the starting date. It just never made it further than that, which, like I said, was by design. Depending on what you're trying to optimize for, this could be perfectly fine, or it could signal a slightly higher risk level, since your depletion time will never stretch past that 30th withdrawal, unless of course you change some of your assumptions partway through retirement. In terms of sustainability, the approach is fairly easy to use, especially with the help of the spreadsheet provided by the Bogleheads. Every year you simply input a few figures and it tells you what amount you should be withdrawing as income. Unfortunately, it does suffer from both the potential drawbacks of the strategies it was inspired by, which, depending on your own personal preferences, may or may not make it harder to sustain over the long term. Like we discussed last month in the video on the 1/n method, what happens if you live longer than you were expecting to? Your margin for error shrinks with each passing year, since you're withdrawing a larger and larger percentage of your portfolio with each passing withdrawal. Now, you can correct for this to some degree. For instance, the Bogleheads wiki recommends using some of your funds to buy an inflation-indexed single premium immediate annuity around the age of 80, so that your total non-portfolio related income, i.e. your Social Security or any pensions or part-time work income you may have, and the income from the annuity, gives you a high enough income floor to live comfortably in those later years, regardless of how your investments go. And they also recommend limiting the withdrawal rate to no more than 10% from then on, but it can still be difficult to see that portfolio value draining over time for a lot of people. And of course, the income amounts can vary wildly from year to year, since you're withdrawing a percentage of your portfolio, as opposed to a static value or an inflation-adjusted value. The third factor that I look at when analyzing withdrawal strategies is the predictability or stability of the income stream it produces. And as we just went over, since the variable percentage approach calculates its withdrawals based on, at least in part, the performance of your investments from year to year, which as we all know can be volatile and unpredictable, it can lead to more of that boom and bust aspect of income generation. Though in most years it will not be as volatile as one would think at first. As you can see from this chart, using the variable percentage approach, your income may fall anywhere from 40 to 50% of the time, depending on the allocation used, which is a lot. However, it is worth noting that, with the exception of the more aggressive all-stock allocation, most of the time, the actual raw dollar change in withdrawals is really quite solid with this strategy, as indicated by its median change from year to year of a couple $100 in inflation-adjusted terms. The fourth and final factor I look at when analyzing withdrawal strategies is buying power. And in this regard, the variable percentage strategy may not be the absolute strongest approach. Those of you who saw the 1/n video last month will know that it managed to roughly triple its buying power over time when using an aggressive allocation. It is still a strong option, as it's raised its buying power over time by several $1,000s under all three allocations. And it did this while simultaneously generating really strong levels of income in the early years, which, relatively speaking, was a bit of a weakness for the 1/n method. So in the end, what we've got is a withdrawal approach that's capable of generating a pretty darn good amount of income, early and often, without sacrificing its ability to grow that income over time. And while it can see some pretty hefty swings in terms of withdrawals from year to year, its typical yearly income swings seem to be held in check reasonably well, at least when you're using less aggressive allocations. What it may not do quite as well as some other strategies that focus on it is to give you a ton of longevity, which could make it more difficult to stick with long term for some people. Assuming you don't deliberately pick out a fairly large number of years for your money to last you, i.e. have a really high end value, or just adjust that end value to a higher number down the road, or even just treat the suggested withdrawal amount as a ceiling on your income, as opposed to the amount you actually have to withdraw every year, the money is only going to last you so long by design. If you're in a position where you're willing and able to adopt these alterations, this may or may not be that big of a deal for you, but it is something worth considering when you're comparing the different withdrawal strategies against each other, nevertheless. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.